Good morning, ladies and gentlemen, and welcome to the ZINC Media Group PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question in the box below and press send. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your InvestorMeetCompany dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll and be grateful if you could respond. That would be most helpful. I'd now like to hand over to Mark Browning, CEO, and Will Sawyer, CFO of ZINC Media Group. Good morning to you.
Good morning. Thank you very much indeed. My screen has slightly changed size, so bear with me 1 minute. There we go. So I'm Mark Browning. Thanks for sparing us the time. I hope you're all well and COVID-proof. So we'll walk you through a short presentation and then move on to the Q&A. I'll introduce myself more formally in a second. I'm just going to turn my camera off for the benefit of this section of the presentation. I'll switch it on again as we get to the Q&A. So you'll see me disappear, but you'll still be able to hear me. Hopefully that is working fine. So we always have the disclaimer, which we will publish in full on the websites and various places, so you can see that later if you need to. But let me just start by summarizing where we're up to on our journey in the transformation of the ZINC Media Group. The critical thing, there have been a number of changes that we needed to make the group profitable and to generate cash going forward. And the key thing is those critical changes that were required to do that have now been done. We actually originally planned to complete all those in this calendar year to the end of December. So we completed them by September, slightly earlier ahead of where we originally planned because of COVID particularly. But specifically to pull out the key things that have been improved and have changed that make the group now set for profitability and cash generation. There's specifically improvement in TV margins. Margins are now 6% higher than when I joined in April, May 2019. So that is a critical part of putting the group in a position where we know it can deliver profitability and cash. That 6% improvement is a big deal. It's a £700,000 swing improvement on like-for-like revenues. So all things being equal, that one change makes a significant improvement to the profitability of the group. That's TV margins. There have been a number of marginal businesses or loss-making businesses in the group, and we've taken the decision to either close them or significantly restructure them so that those are not carrying a drag into 2021. And that itself, again, on a like-for-like basis, would be a further £600,000 improvement, all things being equal, going into the next year. So margins and the improvements in the businesses that have been dragging the overall performance will mean we're going forward in a much better place. And the critical thing is we've now hired new business winning people. We've restructured the group in certain places and we've hired in new areas, in new markets. And those roles are in and developing their pipelines. Market demand is returning. Obviously, we'll come into this in a bit more detail when we talk about the landscape and the market in television and in ZINC Communicate. But the key thing is television is being made. Commissioning is happening. Productions are underway. TV on your screens, and whether it's Emmerdale or whether it's Corrie or whether it's Strictly or whether it's one of our programs, we're now back in production after the hiatus of the spring and summer. And the advertising market, the funding of television, particularly in the UK commercial PSBs, is returning as well to more normal levels. So pre-COVID, this was a group that was nudging 30 million of turnover. And due to the changes that I've just outlined there, and I'll go into a bit more detail on, we know now that on a lower revenue, we can actually still be profitable and generate cash. So we're ready to capitalize when the content dam that has been there for the most of 2021, as channels have contracted their spend and as international channels have reviewed what they're going to do, we're seeing more repeats on TV We're seeing more reruns and so forth. That's because of COVID. When eventually that dam bursts, we're now in a much, much stronger place to capitalize on that. Just a bit about me. It's my third turnaround, if we want to use that phrase. And I'll explain a bit about that in a second. But you begin to recognize when a company has got itself in a position where it's ready to exploit better times. And we are now in that position. So that's the summary. We'll go into the detail. Just a bit about me and a bit about Will. So I was in radio for the best part of a decade. I mean, longer than that, but at heart, I was there for the best part of a decade. And when I joined, that was a number 4 radio station in London, a challenger brand looking to become the dominant brand. And I stayed there, as I say, for nearly a decade or so. And eventually, under Chrysalis, that group was sold. Moved into television at ITM Productions, stayed there for a decade or so, and established that production division within an existing organization that created a profit center for ITN. It was a big turnaround. ITN was facing significant headwinds in 2009, losing money and facing insolvency. So it was a big turnaround. It took 10 years. And the first 2 or 3 of those were naturally the early turnaround moments. But there's a lot of similarities between the ITM production story and the future ZINC story. So I joined ZINC 18 months ago and set about a similar set of turnaround strategies that we implemented in ITN. Will.
Hi there. So I'm Will. I'm a CFO, and I joined ZINC 2 years ago. My background is in media, and I trained at Deloitte in the media practice there, and I then worked at ITM Productions as finance director in tandem with Mark for 9 years. And you can see on the right hand side of the slide the ITM Productions growth story, which is really relevant to the ZINC turnaround and growth that we are planning. So at ITM Productions, when we joined, revenue was 8 million. We grew it to 50 million. You can see the increase in TV hours and the market position. And in the last 5 years we were there, we were growing the business at an average annual rate of 27%. And importantly, all that growth was generated organically. There's no acquisitions, no external investment, because of the type of setup of ITN at the time. So Mark and I both joined ZINC to do a very similar thing to what we achieved at ITM Productions. Very similar business, a content creating business, TV and other non-TV content as well. And the difference being with ZINC is that we can grow it organically, but also at the right points, we can look to do acquisitions as well.
Okay, so let's flip through and bring up to speed on where the group is today. In essence, it's a simple group now to understand. It's a content creating business. Everything we do is about content creation. And in ZINC TV, we sell to buyers who are typically commissioners. They are employed and sit in broadcasters, in broadcasting organizations, with budgets to commission content from us. In ZINC Communicate, the buyers tend to be marketing directors or CMOs or CEOs. But we're making televisual content across the business, the content creation group that is ZINC Media Group. In TV, the buyers are a one type of buyer where they have budgets and they're commissioners. And in ZINC Communicate, they typically are CMOs or marketing directors or CEOs. So in TV, we sell under a series of trusted labels. And the labels do 2 things, really. They help our buyers navigate the type of content that we make across the factual spectrum, what we call in television the unscripted spectrum. So we're not in drama, we're not in sport, we're not in shiny floor entertainment programs yet, but we are in what we call factual or unscripted TV. And our labels help the market understand the type of TV we're in, which I'll come on to. In ZINC Communicate, we sell under the ZINC Communicate label in 3 particular areas: brand and advertiser-led content, where they are the buyer and they're creating content for their brand or their audience; video marketing solutions, which can be B2B communications, internal communications, corporate comms, video marketing, and then digital content publishing. And the critical thing that we've been working on over the last 18 months is to make sure that everything we do sits on the same spine. That we share our customers, we share propositions, we're able to create the synergies and the scale. And importantly, when it then gets into production, we're sharing the video production, same workflows. So if something is made in ZINC Communicate, it sits on the same workflow as something that's made for BBC One. And that creates the opportunity for scale and for greater margins where you're using the same kit. We work with all the UK PSBs. PSBs are public service broadcasters, so BBC One, 2, ITV, Channel 4, Channel 5. And increasingly working with many of the big international buyers and big international channels as well. So the Nat Geos and the Smithsonian's, HBOs, you can see them on the screen there. In terms of awards, again, ticking back to what attracted me to this job is this is a blue chip company with absolutely best in class television and non-television production, as demonstrated by the sort of awards it wins. So in the last 2 years, we've not only won a BAFTA, but then this year we've recently been nominated for a BAFTA as well. So it's right up there in best in class in its sector. Sort of programs we make, well, we cover the full range of factual production from the channels that I've just listed, really. So at one end, you'd have low cost, high volume television, things like Police Code Zero, the Channel 5 program that's on the screen there. That is great television in its own right, but it's also part of the overall mixed economy that we're looking for within the media group that ZINC is. So we've got high volume, low cost in some areas. We've got prime time, 9 o'clock ITV shows. And that is, there's not a lot of indies of the many hundreds that there are in the UK that can boast to regularly have 9 p.m. on ITV. Then there's the reputational programs, the stuff that really the whole tent hangs on, the stuff that wins those big awards and that everybody recognizes are really special in their own right. They rate, but they also bring in the awards. The likes of Cuba and Castro, the likes of Tutankhamun in colour for BBC 4. And then there's the bigger international 4K type work, of which Wild Tales from the Farm for Love Nature and Sky Nature, or most recently our program for Smithsonian would be one of those where you're getting a very much more premium price per hour. They buy in bulk, you get a lot of episodes. They are multi-million pound commissions, often in 4K or increasingly more demanding. So we've got the whole range of mix of specialist factual. I'll explain a bit more about those in a bit more detail in a second. Then in ZINC Communicate, we've moved ZINC Communicate into new markets over the last 18 months, 2 new markets in particular. And the essence of the sell here is that we harness the TV power, the power of TV, for brands and their agencies, for media owners, and for rights holders across, at the moment, 3 product propositions. They're bigger markets than ZINC's been in before. They're markets that we had experience of and built businesses in under the ITN brand when we were there. And we grew our business in this space, from 0 to around 15 million by the time we left a decade later. So we know this market. We know this is a synergistic market. It's an important market for television companies to be in, because you're able to really sell the sizzle of television for brands, agencies, and others who want to tell their stories for their particular stakeholders. So in ZINC Communicate, in the branded content business, we're selling there to for brand entertainment partnerships. So where a brand wants to either attach themselves to a piece of television or create a piece of television in their own right for social distribution, or for YouTube or Facebook or wherever it happens to be. In short form content, they'll increasingly spend their money engaging consumers on digital first platforms in a way that isn't about selling a product per se, but creating the environment to allow the consumer to have greater empathy, greater engagement with their particular brand or whatnot. And then there's advertiser funded television, where there are slots available, typically Channel 4, Channel 5 do some, ITV do some, in the commercial PBs, and internationally it's a much bigger part of the American market, where the advertiser themselves will fund the the program that is needed to be made by the channel. And you've got a three-way partnership between the production company, the advertiser, and the channel. So we have a space now in branded content. Video marketing, again, it was an area we built up in our previous roles under the ITN label. B2B video marketing, marketing for partners and associations in the UK who need to tell their stories to their members or to their stakeholders. We got 2 new clients in the last few months, RIBA, which is the Royal Institute of Building Architects, and the Association of Decentralized Energy, which we're working with at the moment. And we can build that business up in video marketing. The key thing is it's synergistic with TV. So once you've filmed your production, it comes back, it sits on the same spine, sits on the same workflow, and therefore it creates utilization of the resource that we've got in the group.
So the slide that we're on is about the transformation plan. So 12 months ago, we put in place and announced a transformation plan, and all the critical elements of that transformation plan are now complete. So gross margins is a key one. So TV margins back in 2018-19 on TV productions were around 24.5%, and in the last 18 months we've increased those by 6%, and on like-for-like revenues that's equivalent of 700 grand of additional margin. The second thing is that we've closed and restructured loss-making businesses. So in the year to June 2020, there's 600 grand of costs, and they represented over 80% of the losses in that year, which are not going to be recurring going forward. And that's because we've closed our CSR business. That's the corporate social responsibility business, which we were in, which was really niche and small and was not synergistic with the rest of the TV business. And then our Manchester TV business, which was loss-making, we've significantly restructured that. The third thing is we've relocated to a new HQ. And even though we've not been in it as much as we'd like to have been this year, we do have new post-production facilities in there, which is helping to drive those TV margins. But we've also managed to save money by going to that new HQ. So we've got savings of another 100 grand a year on that. As Mark's mentioned, in ZINC Communicate, we've gone into 2 new markets within that part of the business. The post-production investment just mentioned, and then we've got new hires, particularly business winning hires now in place, which means that we're pointing at the right parts of the market, and we've got some big hitters who have come in. And then finally, we've restructured the balance sheet at the beginning of this year. So we made lots of changes to the balance sheet. We got rid of all the preference shares off the balance sheet. We extended the term of the long-term debt out to the end of 2022. And that debt, by the way, is in a sense friendly debt that is held with our 2 major shareholders. It's not bank debt, and those shareholders are very supportive. And then finally, we did a capital reduction, which completed in September, which means that the group now has positive distributable reserves, and means that in the future, it provides the possibility of being able to pay dividends as and when the business is generating sufficient profits. Just going to the next slide. 1 second. So in terms of the new hires within ZINC TV, particularly within London, Tom has joined, Tom Edwards, who's in the top left of the screen. He was formerly a BBC commissioner of popular factual programmes, and is a really big hire for us. And he has been producer or commissioner of some huge factual shows over the years: Eat Well for Less, DIY SOS, Wife Swap for Channel 4. So he's a big new hire. We've got Greg Sanderson, who is third along from the left. He was already part of Zinc setup, but has been promoted to be the managing director of London TV, and he typically books £3 to £5 million a year. Bottom left, we've got Dominic de Turville, and he is our branded content director, and he has sold TV, he sold TV rights, distribution, branded content, and he's formerly Sky's head of sponsorship. And he was also a branded content director where he's been making branded content as well. And importantly, he also brings the skill set and contacts to be able to help to fund or part fund TV shows as well. So he can make content for brands, but he can also help where we're making, say, a £2 million show, of which a broadcaster might fund £1 or £1.5 million of. He can go and find that other £500,000 from brands or from sponsors. And then top right, we've got Katie O'Callaghan, who's our HR director, and previously the group didn't have any HR resource. And then bottom left and one in, we've got Ben Smith, who's recently joined as an executive producer within Manchester, within the newly established Red Source label. So it's just to give a flavour of the new people who are coming in and the direction that we're now taking the business in.
This is all part of driving the growth of the business and getting those margins up, because one of the challenges the group has had is that historically it's operated as small independent TV businesses. And actually there's an opportunity in television to create better margins and create scale if you use the same infrastructure for all of your television businesses. So in London, that means that the 4 TV businesses that we've been operating on historically, the groups had historically, now sit on the same workflow. So post-production is one of the ways that you're able to drive margins up and get economies of scale. So that is now in post, and you can see it on the screen there. We've managed to deliver our first 4K project, which is a program called The Curious Life, which was for Smithsonian. It's quite an interesting case study, because when we budgeted that program, we still assumed we would need to go out of house for some elements of post-production. When it came to actually making the program, which aired in the last couple of months, we were able to do everything in-house, and therefore you're able to recover those lines in your budget without spending them with third parties. All helps to improve margins. Another part of the benefit is that across the group, obviously many of our TV businesses will use voiceovers in different parts of the country, and Turn, as another case study for you, would use London post-production companies for their voiceover sessions, and now they're able to use their own Zinc HQ. So Turn were able to use the London office more recently for some of their work too. So all of that helps to eke out margin improvements as we go forward. We're using less freelancers, more in-house staff, less out of London edit facilities, and more of our own facilities. So that's in place. Let's just talk about the market. Now, this slide, in effect, plots the market opportunity. On the vertical axis, we've got price per hour, and you can see there that the price per hour gets very, very high when you get into high-cost drama in the top right-hand corner. And on the horizontal axis, as I've articulated before, non-scripted TV all the way up to scripted TV. So excluding sport, for the sake of this illustration, the most expensive type of television is high-cost drama, where it's scripted TV and it's got the highest price per hour. So shows like Killing Eve and The Crown, multiple millions of pounds per episode, sit in that sort of box. Zinc, historically, has sat in the sort of vanilla-coloured side. So lower cost television, factually, is lower cost than sport or drama. And in news and current affairs, and in religion, and in general factual. So in blue here are some of the shows, the programs that Zinc makes in factual. So Reflections at the Key is a religious program made out of Turn. the BBC Scotland, Beechgrove, similar, Britain's Wildest Weather, Code Zero, Critical Incident, all programs that are in that high volume, low cost kind of bracket. Then in specialist factual and popular factual, we've got programs like Henry VIII and our 9 o'clock fighter pilots program, which I referenced earlier, and Turn do emergency helicopter medics, for example. All of that stuff is excellent television. But what we've tried to do, and this predates us joining, but we've accelerated this over the last 18 months, is move us to a wider position in the market to diversify our revenues. So factual entertainment is a critical one. Formats, reality. We haven't had a huge amount of television in this space historically, and when Will's just run through the hires we've made, Tom Edwards, Ben and co are all new in that space. It's an opportunity for us to accelerate growth in factual entertainment, and we're doing that under the new label of Red Source. So you see on the slide in front of you the labels we operate in each of these markets. And then there's premium factual, big history shows, big science shows, potentially natural history shows, where the price per episode there can be £350,000 per hour, and the price down at religion and current affairs can be £50,000 an hour. So you want to make sure you have the full spectrum and the full range. So with the hires we've made and the moves we've made in the market, we're now able to occupy the green boxes of factual, which gives us the full range. And in time, we can diversify further out of that orange box. But that's the strategy at the moment. Where do we sit in the marketplace? Well, this is a market snapshot from 2019, and you can see that we're a mid-market player. There's lots of grey bars on our visual in front of you. Each of those grey bars represents a production company. That tells us a couple of things. It tells us some very, very big players, and the market is dominated by 3 or 4 very big players, where they're typically drama-driven companies or sports-driven companies. And then there's a very long tail of lots and lots of small indies. And as a group on the right, we've shown where ZINC Media Group sits. And this plays to our overall ambition to be a top 5 club, to use a sort of football analogy. There's no reason why, other than trading and getting our market cap up and doing all the things we're doing, that we can't become a big player in this space. The market will support it. The opportunity is there, as you can see by the number of players in the market, and we're a mid-ranking player with ambitions to move into the top 5. So it's all about the long-term plan here. We've got the opportunity, we've fixed the short-term problems, and I'm incentivized and was incentivized on value creation. There's no question in my mind that we're sitting on a fantastic vehicle for value creation here. It's ultimately why Will and I left a bigger company, a more secure company in many ways, and certainly a larger company in turnover, to come here, because there's the opportunity for really scaling ZINC Media Group is there for the taking. Now, COVID hasn't removed that opportunity. All COVID has done is delayed when we're able to really accelerate the plan. So we need to scale, and the market is there for scale in the future. Let's have a look at what's going on in the market. This is some of the more recent evidence that's been coming out. So I'll just pull out 2 or 3 of these. There's definitely green shoots of recovery now in TV. And as I say, TV is now in production, and we've learned how to manage with COVID, and we can film under social distancing for as long as we need to. ITV say that they're looking to factual in 2021 to help fill some of the hours that they haven't been able to commission in drama or in sport. Channel 4 issued their annual report only a couple of weeks ago. They're through the worst, and they're seeing an increase in commissioning spend in 2021, particularly in areas like science and in history, areas we're very strong in. BBC 3 are increasing their factual budget. We've got a good, close relationship with BBC 3, and we have 2 former BBC commissioners now in our selling team, so we're well placed to continue to work with the BBC. In the SVODs, the SVODs still present really good opportunities for us. We do have ideas in with the Amazons, we have ideas in with Netflix, and they, of course, in that side of the marketplace, have been less affected by COVID in revenues. In fact, they've seen revenues increase because obviously we've all been sitting at home with more time on our hands and less holiday money going out the door, so people have added an extra subscription or 2 to their media mix. So the SVODs have done fine in terms of revenue. And then there's the multi-channel networks, the Skies, the Discoveries and so forth, all seeing good opportunities for content creation. So 2020 has definitely seen spend slow down on original content. It's seen a surge in repeats, and at some point, as I say, in 2021, that dam will burst. There'll be a rush for new original content, and we're well placed to be able to pick that up, and you can see there that the signs of optimism are returning in the market. What does it look like for us for 2021? Well, we haven't got a forecast in the market, and we're not putting one out yet. But we do have an increasingly rigorous approach to our internal systems that give us much greater visibility than the groups had before. We've booked into 2021 already, just over £4 million. We've got a healthy amount of new business, and we typically plot our pipelines according to a series of tests that we apply to each program. And for something to be highly advanced or highly likely, it has to have passed a series of quite rigorous tests. We need to have had, pretty clear signals. We need to have had verbal commissions, potentially the budget's being done, the channel's just waiting to sign off, or it's with business affairs. So we've got good visibility of a slate of business that will come through in 2021. Then there's programs that sit where there is expression of interest from a client. Perhaps the budgets are being in the early discussion. A commissioner is engaged with the idea, but maybe the idea needs to go through a more formal commissioning process. There are returning series in this part of our pipeline, and there are returning series in our highly advanced as well. And that's a critical part of building the business in the future. And our experience tells us that broadly, as things develop here, when something is highly advanced, you may end up winning a significant proportion of that. You'd expect the bulk of that 11 million to land in the coming calendar year. And as things go in that engaged discussion area, you probably expect half of that to fall through at some point in the future. And then there's obviously lots and lots of stuff that goes on in early conversations that eventually works its way through the system. So the headline for me is that there's plenty of activity, plenty of interest, there's plenty of ideas to allow us to deliver on the plan in 2021 once the COVID scenario plays out more fully and confidence returns to the market. So as we kind of bring this section to a close, let's just look at the sort of headlines of where we see it. The changes we've made have meant that we're now correctly structured, we've got the right cost base, we're in the right markets, the profitability and cash generation once the COVID cloud passes through in 21. And that's because we've shut or restructured areas of the business that weren't profitable enough or couldn't be profitable enough in 2021. We've improved those margins. We're now operating at levels that mean we can win and make TV profitably on the production itself rather than just on the secondary revenues. We've got the new hires in place. We've got a full squad of people who are building their pipelines. We've got ZINC Communicate in the new larger markets. We've got business winners in post, and we're seeing much higher average order values potential coming from clients in that space now. The publishing business under ZINC Communicate is now performing back at the same levels it was pre-COVID, which is outstanding turnaround for that group. And we've got pipelines and financial forecasts that give us the transparency and the visibility that we need to be able to see the future much more clearly. So we've got enough business in the pipelines. We know we can now generate cash and profitability on a lower cost base than previously, and therefore we're set for a much brighter future once the COVID period passes through. So that sort of ends, I think, this section of the presentation, so we can move to some questions and answers and a discussion.
That's brilliant. Thank you very much indeed, Mark and Will, and apologies for the brief interruption. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the company take a few moments to review investor questions submitted already, I'd like to remind you that a recording of the presentation, along with a copy of the slides and the published Q&A, will be available from your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company. It really does help shape future messaging and give them a great idea of the thoughts of shareholders. And immediately after this presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Mark, Will, obviously we've had the opportunity to have questions pre-submitted, and also we've had a number of questions that have come in during the live event. But I wondered if I could just start off with some of these pre-submitted questions, and perhaps if I could ask you to pick these up where it's appropriate for either you or Will. The first question we have is why has ZINC historically struggled to be profitable, and how do you propose to turn it around?
I'm happy to take that one. I think let me pick out 3 or 4 reasons why it struggled historically. Poor margins was one. It's critical that you can make TV at the right level of margins, and that's about eking out 0.5%, 1%, an extra 2% every time you do a TV show. So poor margins was one reason why historically it hasn't been able to make profitability, and that has been fixed. Loss-making businesses, visibility of loss-making businesses have presented a drag, certainly for the last couple of years in ZINC Communicate. So resolving that means that we can be more confident that going forward we're not carrying any sort of weight. Not seeing itself as a group and instead operating as a series of small owner-managed businesses has meant that the economies of scale haven't been fully realized. And I think there's something around, and all these points were addressed in our 4-point transformation plan, because the third area we looked at there was cultural and creative renewal. And there's something culturally about needing to be more confident commercially, being confident to talk with clients about margin management, being confident internally that you know how to really drive profitability, being motivated and rewarded on profitability, not just on turnover. And so lots of little things have been changed. So our staff are rewarded on profitability and margin management, not by just winning high revenue business. There's no point winning high revenue business if you can't retain profitability from it. So there's been lots of reasons why I think culturally, commercially, operationally, it's struggled to deliver on the profitability. So that's the main 4 reasons.
Thank you, Mark. I guess there wouldn't be a presentation without a question around COVID, but the question is, what has the impact of COVID been on the business? And I wondered if you can touch on that a little.
Well, we've reported this on the last couple of trading updates we've done. Initially, everything stopped. Everything stopped in the whole sector and in other sectors. And we had a lot of production that was paused. We really didn't lose business as a result of COVID. It's all been about timing and delays. So the primary impact of COVID has been on the market's appetite for commissioning. Initially, the impact was on being able to make television, but from the end of the summer and going forward now, even in the new lockdown that we're in, TV is still in production. You can see it on your screens all over the place, whether it be live TV or recorded TV. We're able to make TV. So the primary impact has been on the market, and that element is still there. I think we can see, as I've shown, we can see the green shoots that the recovery is coming. Channels are feeling more confident. ITV's revenues have recovered. Channel 4's revenues have recovered. The SVODs have seen an increase in revenue. So we know that the ability for them to commission is there. We know the will is there. The question has been risk and appetite to actually deliver on it, and that has now been resolved. Insurance was a reason why TV production had a degree of hiatus over the summer. That has been resolved. Insurers are now insuring television, and where in an odd case they can't insure it, the government have underwritten insurance for television. So all of the blockages that were there have actually been removed. And I think now we're really just down to confidence and speed of commissioning.
Thank you very much indeed. A question really, I guess, in all shareholders' mind is, I mean, and of course you do, but perhaps you could just elaborate on it. Do you have a plan for creating shareholder value?
Mm-hmm. I mean, yes, and that's what we're here for. That's what Will and I incentivized on. As I said before, it's the reason we joined the group, is that we see this as a vehicle for generating value, as well as having a good job and making great TV. The transformation plan that we laid out, the 4 strategic priorities, were all about creating shareholder value. Diversification of revenues, that's critical, both within the TV market and within ZINC Communicate. That gives us this scale. It de-risks the business from changes in any particular channel or any particular market. The more buyers we are selling to across the spectrum of TV and ZINC Communicate, the greater value we will create. Profitability and cash generation are the critical thing. Once we get to a position where we've got profitability and cash generation, we will see the value creation start to come through. We know that, and I know I'm not putting a forecast out, but we know anyone can do the maths on our market cap. We know this is a 25 to 30 million pound group. We now know, and I hope we've explained, why it has struggled to generate cash on turnover of 29 to 30 million. And the changes we've made mean that we are now confident it will generate cash on 25 to 30 million. So we now know that the market cap, based on the multiples of how these things work, whether it be on turnover or on EBITDA and cash generation, we can quite simply do the math on a £30 million group that this business has been before and will be again, that we now know will generate cash as a result. As soon as those two elements start to return and all the changes have been made to allow that to happen, we know that we're sitting on something that is undervalued at the moment, and therefore the multiples will come through on shareholder value. And of course, at the same time, diversify the revenue, build out the business, and then look to scale. And as we scale, we'll do it once we start to see the things I've pointed out beginning to come through. We've got an opportunity here to be sitting on something that was considerable shareholder value going forward.
Perfect. Thank you very much indeed. Will, obviously I'm mindful that, that there's a number of questions here that I think probably fall more under your umbrella, and having just mentioned forecasts. The first question here is, why are there no forecasts in the market, and when do you anticipate being able to release some?
Yeah, it's good question. So we will be releasing a forecast as soon as the COVID-related uncertainty has settled down. And we were due to release a forecast earlier this year, just when COVID hit. But I think it now makes sense to do so once the market's more settled, when there's more short-term visibility. But we absolutely recognise the importance of providing the market with forecasts, which will then give investors the confidence to back the stock, and then will improve the share price. So it is certainly something that is on our mind.
Perfect. And I think the other one that I felt was perhaps more directed to you is, isn't most of the value of production companies made from selling rights? And how much money do you make from those rights?
Yeah, and I think this actually also relates to one of the questions that's come in during the presentation about what value is there in the past program library, and the answer is that we make do make a healthy amount of money from selling our programs. We've got a large catalogue of programs, and we've got a distribution deal with the commercial wing of the BBC Studios, and they're a world-renowned distributor of TV content. And just kind of by way of background, we retain the rights to programs that we make for channels in the UK, and then we can sell those programs abroad, typically to English-speaking territories. And then when we're making programs for overseas broadcasters, such as a National Geographic channel, they typically would retain the worldwide rights for those programs, because they're broadcasting all over the world. They've got their channels in all those territories already. But with those kind of programs, the budgets are typically 300-400 grand an episode, and then they'll order 8 or 10 episodes at a time. So one series will be worth millions of pounds. So the key for us is, first and foremost, that we make a profit on the primary commission, which we now can do given the significant increase in the gross margins of programs. But it's also about having a mixed economy of having some of these large scale international productions where we've got limited rights, and then the UK productions where there's an opportunity to retain rights. And we're well into kind of 7-figure sums of kind of distribution revenue. So it does form a really important part of our revenue mix, particularly because it's then high margin, as the program's already been made, and then typically you might have some distributor commission and possibly a little bit of costs to reversion those programs for particular territories, but they are high margin revenue. So it's also as we're moving even more into kind of the popular factual entertainment space, that's where typically there are more rights and potentially formats to shows as well, which we're looking to drive distribution revenues even higher.
Thank you very much indeed, Will. I am obviously mindful of time, but I'm also mindful that you've received quite a few questions throughout this presentation. We do have a few more pre-submitted, but I do think it might be interesting because there is an overlap, as I think Will, you just highlighted, as to whether or not you could perhaps start at the top. If I could ask you to read out perhaps the question and perhaps give a response where it's appropriate, that'd be great.
Right. Well, there's one here from Bill. Let me read this one out. As a long-term shareholder, I've always felt that Zinc was far more interested in making interesting documentaries rather than making money for shareholders. Having increased your TV margins to around 30%, how much more is there to do before this company can start making real money for its shareholders as opposed to its already well-rewarded staff? Very fair and reasonable question, Bill. So I hope I've answered some of this in what I've said so far about changing the culture and changing the reward structure for everybody, focusing the business on profitability and margins rather than the sort of, there's this thing about the lifestyle business. I'm really aware that the company has been regarded by some as being a bit too much in the lifestyle territory and not really commercially driven enough. And hopefully I've reassured you that the whole way that the company is now orientated is around driving profitability and cash generation so that we can both reward our staff and invest in growth, but also reward our shareholders and create value generation for them and for us. And that's ultimately why Will and I have joined here. So the second part of the question, how much more is there to do before this company can start making real money? Well, all of the building blocks are in place for it to do that. That's what this first phase has been about. We do need the revenues to return. And had COVID not hit us, my experience of doing this for the third time would be we would be in that position now. And so it's a question of when, not if, I believe. Once the revenues return, all the building blocks are in place to create that profitability and cash generation. There's a question here from Abby. Could you give me an idea of the scale of the business, i.e. the number of employees? Also, future growth, do you see future growth organically or through potential acquisition? And the second part of that is easy to answer. That's both. Once we've right-sized the business and the revenues are returning, we're kicking off cash and profitability, then we would expect to be able to grow organically as we did at ITN. And we pointed out the growth charts of ITN in its last 5 years. We were there in the 10-year period, but we were growing organically from third or fourth year. So we would expect to see that and build a plan, and we would want to scale the business, and we've demonstrated through some of the slides the market is there for that. On the first half of the question, can you give me an idea of the scale of the business? There's around 120 permanent staff across the group in the various divisions. And then, it's got a freelance base as well. So you're often on programs hiring in freelancers, contractors to deliver expertise that you wouldn't normally have within your staff base, whether it's a director or producer or an editor or whatnot. So a fixed sort of, or our permanent staff, people who are employed on contracts with us day in, day out, is around about 100 across the group, sometimes a bit more, sometimes a bit less. And then there's probably a similar number at any one time doing freelance, depending on the number of programs we've got. And we have bases in London and Manchester, Macclesfield, Belfast, Aberdeen, and Glasgow, and a sort of emerging base in Bristol. Nick has asked a question: what visibility do you have on revenue? What additional resource do you need to get to your target to be a top producer by turnover? Visibility-wise, well, the best visibility I've shared with you how we operate in our sort of forecasting and pipelines. Visibility is hard. There's no question that visibility is hard. And COVID, it's hard for everybody. I was having a conversation with a channel only last week who had 2 programs that it thought it was going to put on its schedule disappear, and they're not gone for good, but they've been delayed because the particular production company they're working with is struggling to just get access to a particular individual or set of individuals because COVID rules have changed somewhere, or an individual has been affected by it. So COVID's making it quite tricky to forecast accurately what we're doing, which is why we're not putting a forecast out. But we have got enough visibility to be confident that once those unforeseen COVID things disappear, we know we can get back to being the group of 25 to 30 million turnover, and we know we can generate cash and profitability. In terms of resource, we have the right resource. We have as much resource as we need now to get to that first or next phase of delivery. I want to really be focused on profitability and cash generation, and then we will be able to see the market cap improve, and we'll be able to talk about further investments in growth organically or through M&A. Let me just see a few more that are coming in now. Let me just see this one here. What value is per program library? I think we've answered that one. When you eventually, this is from Bill again, when you eventually provide a profit, will you release it to the market in general as opposed to a few chosen shareholders? If not, could you at least release a broker's consensus figure, as several well-run companies often do? I think that's a fair point, Will. Bill would take that back to our broker and do all that. I mean, it all relates to the ability to us to put a forecast out, really. And I'm hoping that you're seeing from this that, while we've been in crisis mode and crisis management mode, as everyone has managing COVID, it's critical for us that we engage all of our shareholder base equally and fairly and give everybody the same opportunities. Now, just on that, there might be something in there about the raise. I do want to make it clear that when we did the raise, we did look to offer opportunities for all investors at all levels to enter into the fundraise a couple of weeks ago. It wasn't possible for us to do it for a number of reasons. We wanted to do it through a third party, and they weren't able to help us on this occasion. But I want you to be reassured that it was very, very high on our minds, and on the minds of our institutional investors too, that we wanted to make sure that everyone contributed, which was one of the reasons why we were pleased that we were able to do it at the par strike rate of price, so that everybody ultimately had a chance to come in on that raise at that price, and still obviously can do so. So I'll take the other points, the sentiment point about our transparency with all of you forward with our brokers, M+1 singers. Okay.
Mark, shall I just take a couple of the other questions on the one of them being how much money has the new management team invested in the business? So we've on the board, 4 out of 5 of the board have joined in the last 2 years, and the board have collectively put in over 150 grand into the business. And what was the next question I was going to answer? So David's also asked, what is an achievable EBIT margin in this business? So typically kind of TV and content creation businesses typically run at an EBIT margin of anywhere between 8 and 12, sometimes up to 15% EBIT margin, and that is what we will be aiming for, to be in that range.
Just one quick one. I think someone just picked up on my comment just a minute ago. Why didn't you use primary bid? We did look to use primary bid, Abby. Perfectly reasonable question. I mean, we asked them to consider it, wanted them to do it. We couldn't make it work with them. Singers did their best too. So that was the main reason. But be reassured, it was absolutely what we wanted to do. We couldn't pull it off with them. Okay, they're the ones that are on there.
I think, Mark, by just looking through and scanning the questions that have come in, I think you've probably touched on most, if not all. I don't know if you want to have a quick review. And of course, to investors that have submitted questions, if we have omitted, obviously there is the opportunity to review these post the meeting as well. So, Mark, unless there is anything further, perhaps I could ask you to wrap up, and then I will redirect investors to give feedback.
Well, apologies for falling off the system. I've got no way. I spend all my life on these systems, and it hasn't fallen off before. But that's the way it is. So, appreciate your time, interest in our company, support for our company, and I hope that we've been able to share with you what we've been up to and where we see it going. And I do genuinely believe that the future in 2021 is considerably better than you've experienced historically. And certainly that has been the case in 2020. So thank you for your time, and we'll do more of these as we go forward.
Mark, Will, thank you very much. And on behalf of InvestorMeetCompany, I do apologise if that caused anyone any inconvenience. But hopefully, through the presentation, the Q&A, you now have greater transparency on the company itself. Could I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide feedback, and we'd be very grateful if you could provide feedback to the company. That would be fantastic on its operations and your views on the business itself. If you access this meeting from our website, the feedback page will appear. If you access access via the link sent to you by email, then you'll be asked to simply log in and to then provide your feedback. On behalf of the management team of ZINC Media PLC, I'd like to thank you very much indeed for attending today's presentation. That now concludes today's session, and good afternoon to you all. Thank you.